everyone, this is Gilbert Jalad. I'm talking to you here from Private Corporate Counsel downtown. This is Tufts On Tax, where all your tax questions and answers are right here with Mr. T. Scott Tufts, the master and the expert when it comes to taxes and tax laws. You can call him at 877-647-7887. That number is 877-647-7887, or you can call him on the 407, which is the same number, 647-7887. You can email him at stufts@pcc.law. Again, that's stufts@pcc.law. T. Scott Tufts, how are you today?
Hey, good to be with you.
Good to be with you too, and we have a new topic today. I don't think we covered this one before.
Nope.
So this is about profits, interests, new developments. What is this about?
Yeah, so let's kind of look at a couple things here. The LLC that we talk about a lot, a partnership for tax purposes.
Okay.
If you have something like that, there is quite often a situation where someone will want to provide a interest in the company that will have a concept of compensation to it. So let's think of terms like sweat equity. Or let's think of how do you do that? And one of the things that happens in the tax world, Gilbert, is if you look at the K1 and you look at the left side of the K1 for a partnership, you'll see there's a section where you list your name as a partner, the partnership, and it's got all this information. We've talked about this, and as you go down the line, there's a point in time where you're asked to describe the capital count of your interest. Now, a capital count for our audience, just to remember, is a way of tracking your money in, your investment, your capital, your income earned during the year, your share of the income, your share of deductions, and then your ending capital account balance. And what happens is this is your running idea of what you have invested in the company, okay? So capital count is a critical term. Now, when you look at that left side and you're breaking down what is a capital account, you also have to remember that you've got a component of flexibility there that you can further break down. And what am I saying? You can have a percentage in these partnerships under these LLCs that does not need to be the same like with S corporations. So we think of S corporations of having be pro rata, no preferred interest, etc. Now, let's go over the partnership vehicle. Gilbert, you and I can be 50-50 partners sharing the profits of the business. Mm-hmm. Make sense?
Yeah.
But we also can write into the agreement, if for some reason we want to, different percentages for the percentages of losses. Okay?
Interesting.
We can change it up.
Okay.
Now, we have to change it up where it has economic substance, and there's some rules on where you can't. You have to keep track of it a certain way in accounting and so forth. But just generally speaking, these partnerships have the flexibility that you can do whatever you want in the structuring in a negotiation with another partner to decide, hey, we want to share profits and losses different. Now, the capital. Let's say you and I want to be 50-50 partners, and you are coming to the table with, capital. You have money. You're the money guy. I'm got nothing, but I'm going to put blood, sweat, and tears in, right? We might call that equity partner, right? Mm-hmm. Now, for whatever reason, since I'm going to be working in the business, you agree that 50% is worthy of my effort, right? Mm-hmm. But you're putting up the cash, right?
Okay.
Now, I'm going to contribute services. Agreed? Under what I'm describing, the example.
Yeah, which a lot of people do. Some of the businesses
Correct.
Are like that.
Now, the problem becomes that if you put up cash and I put up services, right? And the moment we start working together in this partnership,
Making profits.
if on day one we have this arrangement, mm-hmm. your money, I'm services, and you agree at that moment of formation that I'm already entitled to 50%. Let's say on that day 2, we suddenly hate each other and we dissolve. Do I get half your cash?
Of the remaining at that moment?
All right. So you put up 100,000. I got nothing.
Yeah.
But I'm gonna be services and I'm gonna do it.
Well, according to the agreement, yeah.
You just shifted half, 50% to me.
Oh, yeah, that's because he didn't put the service yet.
Right, but we agreed that I've already earned it.
That's interesting.
Right. Now you would, as you think about it and you get good advice, you'd say, oh, wait a minute. You got to earn it.
Yeah.
Right?
Yeah.
So you'd say, I'm going to give you 50%, but it's restricted. It's going to be based on that. Are you going to still be not employed because you're not an employee, but or am I going to, in the example, am I going to be still working? Do I have to go 3 years before it happens? Do we have to?
So you have to put a time if you put.
And what about it? Do we have to be successful? What happens if I'm working but it's not successful? Does that matter?
Okay.
What conditions are you putting on the 50% interest?
Exactly. Right? You can't leave it just open.
But you would imagine there are people that just jump right in, right?
Yeah.
Because you could take your 100,000 and loan it to our business, right?
Yeah.
Right?
Yeah.
And you could draw up a note, yes, and say, I want it paid back in 5 years.
Yeah.
That's not capital.
Oh, wow.
It's not at risk.
Yeah.
See, right? When we put up capital, we're talking about 50% at risk that if it goes belly up, you lost your money, right?
Yeah.
Now, capital is needed to capitalize a business, right?
Absolutely.
All right. So going back to what is a profits interest? Well, we're isolating the profits component. So in that same example with you and me, and you're putting up money, is there a way for you to incentivize me? Right? Let's say you say, Scott, let's do this. I want to be the 100% owner. So far, so good?
Yeah.
And I say to you, I don't want to be an employee. Or maybe I do want to be an employee. We could do that, right?
Yeah, we can.
Okay. But I say, no, I want a profits interest. I want to take a stake of whatever. Can you then say, I tell you what, I'll give you a 30% profits interest. Okay? Now, if condition, right?
Correct.
And when those conditions are no longer conditions, and I've earned it,
then you
maybe that's a time when the government wants to do what? Tax it. Yes?
There are taxes. I forgot about that.
So now let's not get lost. So let's go back to the idea that generally when we form a business, right? And we start a partnership, whatever we're putting in, there's no tax when we're starting, right? We're just going to keep track of what we put in, how we do, and then, right? Now, if we take money out of the business, profits or whatever, then that would make sense when you would tax it, right?
Yeah.
But as we've always learned on this show, things aren't so simple.
No, absolutely not. Not for taxes.
And it's possible for on the front end to have taxes occur because of not structuring it the right way, right? All right. So what's going on with a profits interest? Let's hit that. So a profits interest is something other than a capital interest. And so the government, in their wisdom, made it pretty much a profits interest is anything other than a capital interest, so therefore you must know what a capital interest is. All right? A capital interest, as defined under this revenue procedure that's discussed in a recent case, is a interest that would give the holder a share of the proceeds if the partnership's assets were sold at fair market value and then the proceeds were distributed in complete liquidation. So in other words, Gilbert, remember what I was saying? What would happen if the moment day 2, we changed our mind and we decided, the business isn't going to work. I mean, let's put some practical out. 6 months, we say, it's not working out. We did it sloppy. We don't even have an operating agreement. We just whipped it together, and we get to the accountant. The accountant says, okay. And you go, well, we took a shot at it. We didn't make it. And he goes, well, how did it go down? And you say, well, Gilbert put up $100,000. I put up services, and we spent it, and it didn't turn out so good for whatever reason. I mean, obviously an exaggerated example, but we're trying to bring the point home that we then go see the accountant. The accountant says, all right, you're under oath. What percentage are you, Gilbert?
50%.
And what am I?
50% services.
And I'm writing down capital on the capital line of my little K1. What is it going to say on the capital line? 50 or 100?
For who? For you? Or
for me, yeah.
Oh, okay. 50?
But I didn't put it up.
No, not yet. Not in 6 months. I mean, you didn't finish the year.
Exactly. So the point being that we got a capital shift of your 100,000. We got a shift of 50,000 to be taxable to me. So here we had a deal that went belly up, but yet I earned 50,000 in the process. Correct?
So you're the winner here.
I'm the winner, or am I?
But I mean,
I didn't get the money.
Taxed.
Hold on, not so fast. What else have we said on this show about partnerships? And you get a K1. You can get a K1 that says, here's your income. You made 45,000. Here's your share of the profits, 45,000. And you say, I didn't get any cash. I didn't get any distributions. Do I have to pay tax on it? Yes.
Yep.
Because you reinvested the profits to keep the business going.
Yeah.
Right? But you didn't get any cash to pay the tax. So your agreement, you want written in there, you're going to help me pay my taxes each year by taking distributions and give me some help. How many people do that, Gilbert?
Not so many.
So you can see the problem?
Even at 2023.
Yeah, so you can have a K1 come to you that lists some number on it. You didn't get the cash for it. What do I hear? How can I be made to pay tax on something I didn't get? They say, oh, you got it. You just agreed to reinvest it in the business. It's as if you got it and gave it back for the sake of the business. But you still got to pay tax.
So now the answer is, he's at a loss too.
Yeah,
he's not the winner.
Yeah, so you see what's going on. So my point to you is that, when we look at what is meant by a profits interest, we're just scratching the surface. And I think what we do in this program is we tell people there's a form. Then when we look at the form, there's a lot in them, right? There's a lot of questions on your tax forms. There's a lot of data being gathered. But now we get into it and start looking at it and say, there are terms that are magical in the tax law, right? But you better go underneath that and make sure it's what you say it is, right? I call it, we've talked about what Lincoln said, you call a tail a leg on a dog. It doesn't make it a leg. It's still a tail. I don't care if you run around all day long on Sunday, right? And say, it's a leg. Because everybody can look and say, no, it's a tail, right?
Yeah.
So we've got the same problem in the tax law. We've got terms, we've got things, and we need to focus on that and know that those terms mean something, and then you can't be lazy. You got to get underneath it. So with profits interest, I've heard folks say that, but there's actually a definition that it must meet to be that. And if you go awry of that, you can find yourself not having a suspension of the tax treatment that you want. Okay? Yeah. So the key there is you don't just walk in and say, I'll take my, we had an agreement and it was a profits interest. You better make darn sure that everything aligns, both the agreement, the actual structure, and then the K1, right? And all that, because you can then trip yourself up. All right?
And something that's across the board, and I hear you saying it all the time, pay attention to the details and make sure to put everything on there. All the details, everything that you need to take care of.
Talk about like an operating agreement stuff, or whatever it is. Yes, and what happens, Gilbert? Nobody wants the 45-page operating agreement, right? They want the 3-pager, right?
Which they will
regret. Or maybe the single spacer with with very tiny font, right? And sign your life away, right? But we have to realize that
it's a choice you make.
A choice you make. So we want our audience to say, wait a minute, slow down, breathe, and look, right? Investigate, research,
exactly,
and understand these concepts, because there's too much. And so we know these partnerships are out there, these LLCs, the 50-50s are a ton of them. People just go in and say, I'll be 50-50. Mm-hmm. They don't do an operating agreement. Years go by, the accountants are doing the best they can to report it, but then something's going to happen, especially when you're not two apples jumping in together. You're an apple and I'm an orange. Why? Because, I'm doing services that are taxable unless we do something, and you're bringing the capital, right? Yeah. Or you have the money. You're going to be the money guy or the money gal, and you're going to loan money. Or are you? And then what are we going to negotiate over? Like, what are the terms to pay it back? You could call it a demand note. Well, that's great, except what? You could demand it at any time. 3 months later, I don't like you anymore, right? I demand my note to get repaid. Now you're a creditor. Forget whether you're a partner or not. You're now a creditor. So you just, again, I think, Gilbert, at the end of the day, even with this, you get a term that people can throw around. But if they don't get underneath it, mm-hmm. and then make sure that that agreement defines it, or profits interests are usually done by separate agreement. We can do that for folks, but it's got to be, mm-hmm. Dealt with.
And like you said, if the people they want 3 pages, or they don't want to deal with the 45-page, they can have someone like you to be on their side to make sure all of this stuff is in order, right?
Yeah, 100%. And then if you don't get to someone experienced and they're right, mm-hmm. then you kind of also have to ask, have you been there, done that? Right? When you go to an advisor, you should really
make sure.
Yeah, you gotta say, have you been there and done that? Mm-hmm. Is this your first rodeo with the particular topic or the particular matter? Because it's important. Now it might be, but if they're, because they might have the acumen of having enough experience, whatever. But still, just these are the things that our clients out there or consumers out there need to be thinking about when they go to someone like me to address these issues, right? So, but today's topic, this profits interest, is a specific aspect of LLCs and partnerships, and there's a whole lot more to it. So one of the things that in terms of a new development is to point out that this profits interest has come up in a case in May of 2023. Okay, it's an ESNPA holding case. But the reason I mention it is that we oftentimes will hear folks say to us, yeah, that's so complicated, it doesn't get litigated, right? It's not something the IRS understands. This would tell you that if it's being litigated in the tax court mm-hmm. in 2023...
that means they do understand.
Exactly. So these forms we talk to folks about, Gilbert, we talk about how they lead to litigation. And so your left side of your K-1, if messed around with, can lead to litigation. Why? Because I get my K-1, you have your CPA prepare it, and I get it and I don't look at it. It's a problem.
Yeah.
I get it, I look at it. It's a problem. And it's a problem not because you are doing anything other than you would be expected to do, but we might have a conflicting interest in that what I look at, I don't like. Correct?
Correct.
And this happens a lot. So our last message to the audience is think through these things, get good advice. Also make sure you're getting advice specific to you, right? Have your own accountant look at something, right? If you're in a partnership with someone else, does the entity have an accountant? Do each of you have an accountant? I mean, we all hate to have to pay all the, professionals, but if enough's at stake, do it.
Yes,
Do it.
absolutely. It's worth it.
Yep,
It's worth
100%.
it. And you heard them, folks. Have someone to advise you the right advice, gives you have experience like Mr. T. Scott Tufts here. Either if you're at litigation or before you get into anything, have his advice by your side to give you all the information.
Yeah, certainly on that point, Gilbert, just to cut in real quick, litigation's all well and good, but you hope to avoid it.
Exactly.
Right?
They want
So
you
you
on
wanna
their
be on
side if it happens.
So
but-
you want to be preemptive, and I think that's the other thing. We talk about you can't sit on a K1 and not take action, but that's the time to get it fixed. So if you think about it, you notice that when we talked about a K1 not being right, we shouldn't think about, well, I'm going to sue him, my partner, right?
Yeah.
What should I do? Your partners. I go to my partner and say, hey, I got a question, right? What's going on with this? You see the difference?
Yeah.
Why? Because maybe you go, hey, I agree with you. Let's fix that.
Yeah.
And so then you've avoided what? A dispute, a blow up,
Litigation.
possible wrecking of the business. So again, I think we understand each other that K1 can be the starting point, not the battle cry,
Correct. Yes, you heard him, folks. You can call him anytime at 877-647-7887. That number is 877-647-7887. You can listen to him on YouTube, watch him on YouTube, listen to him on Apple Podcasts and Spotify. You can reach him at stufts@pcc.law. That's STUFTS at pcc.law. Thank you and have a great day.